What to make of that with Bill Pulte of Pulte Capital? He's the CEO there, and Bill has an interesting take on this, which I guess kind of mirrors what Kevin O'Leary was saying with us earlier, that this is on the bank. This is on, certainly in the case of Silicon Valley Bank, bad management practices, and someone must know what was going on there or had advanced knowledge of what was going on there that could have precipitated all of this. So Bill is offering a whistleblower $50,000 to uncover any crimes that lead to the conviction of a Silicon Valley Bank executive. I hope I got that about right, Bill. But where does this stand and why are you doing it?
Well, I'm doing it, Neil, frankly, because a lot of cases you have here, you have a government who's obviously going to be looking into this. Sometimes they take too long. What I'm trying to do is really say to people, hey, if you guys have any information on this kind of stuff, we as philanthropists, as people in society need to step up and say, what was going on here? You know, Neil, and we know this from our family business, Pulte Homes, which was our old family business, that executives sometimes can think that they own these companies, Neil, and they don't. The shareholders own these companies. And so in this case, we just need to see, why was this guy trading stock? What was he doing? And obviously now there's a huge bailout that the taxpayers, I think, have to pay. And that's not necessarily fair, in my opinion.
I hear where you're coming from. It echoes the view of Kevin O'Leary to a lesser degree, Carl Icahn, with whom I also chatted. But what if the guy just did something idiotic, not deliberately criminal? He misgauged the timing of bond and treasury note purchases that boomeranged on him. Bought too early, sold too soon. He would argue I had to sell when I did.
I mean, maybe
because
we'll
people
see.
needed cash. Go ahead.
No, I mean, maybe we'll see, right? I mean, you know, we want to give people the benefit of the doubt. People in this country are, even though these days it doesn't seem like it, are innocent until proven guilty. So, you know, let's see if he's innocent. But in the meantime, there's significant ramifications for this, Neil, and we can talk about it. But the mortgage market in particular is going to be affected by this. And this is going to have significant downstream effects in the economy, in mortgage financing, and in the financial industry in general.
You know, in the macro picture, you could say for the mortgage market, maybe it helped a little bit that there was concern here, a flight to quality in bonds in the 10-year and all that, that reduced mortgage rates that have since come back a little from those lows, but that in a perverse way it helped. What do you think?
Neil, I'll tell you, I think you're exactly correct. I think the big problem here is potentially by bailing out the depositors, you're essentially allowing banks to invest in mortgage-backed securities. Now, for the mortgage market, Neil, that's going to mean that it's going to be very good for the mortgage market because essentially these banks are going to have zero to no risk, essentially, in investing in mortgage-backed securities that have, in some cases, the higher yields that are maybe more risky than some of these, 10-year Treasury notes, some of these government bonds. So this is a huge deal, the fact that, the federal government is going to essentially backstop what could potentially be significant investment in the mortgage bond market. So, Neil, I think that's actually quite bullish for the rates from a consumer perspective if they keep this up. We'll have to see what happens. We'll have to see if that truly is. They're going to bail out these depositors at all these regional banks. But if they do that, Neil, you're going to see a lot of people be buying mortgage bonds.
Yeah, and you're right about the unintended consequences of that. If there's no punishment for making a stupid move or even an idiotic one or even a deliberately potentially criminal one, what's to stop that going forward? I do want to get your take, though, on what you make of what the Federal Reserve does next week. I know you're not in the housing business per se anymore, but you follow, obviously, the markets and the mortgage industry and real estate at all. And I'm wondering, there's a growing consensus building, I don't know how reliable it is, where the Fed might hold off next week, that this is not the time to hike rates. How do you feel about that?
I think they've got to do at least 25 basis points. We'll see what happens. But I'll tell you, Neil, this is a huge seismic thing, the fact that they're going to be backing these depositors, because if you're sitting on an investment committee of one of these banks and you're saying, wow, should we be investing in mortgage bonds? You know, we all know what happened with the MBS market in the Great Recession. If all of a sudden you as an investment committee at the bank are saying, wow, the government's going to potentially come in and bail us out if we have any problems, that really changes the whole landscape. So I'm not even so sure what 25 basis points will do if that's the precedent that we're setting.
And by not moving, and I want to put words in your mouth, Bill, by not moving, the Fed would essentially be endorsing that.
Correct. Correct. And I think if they continue to bail out these depositors and stuff, you're going to continue to see, in my opinion, a lot of these regional banks invest in mortgage-backed securities, mortgage bonds. But, Neil, I'll say this. If they don't do this, I think what will happen as a result of the Silicon Valley Bank thing will be that you'll have regional banks not wanting to buy a lot of these mortgage bonds, or said differently, you might see some credit tighten up at the regional level for mortgages, which would actually be bearish for housing. So we're really at kind of this two-way street now. We need to figure out what the government's going to do, because they're two very different directions, in my opinion.
You know, Bill, I've talked to a lot of people. Somehow they come to me for financial advice, which is dangerous. And they actually say, you know, Neil, I'm in a small bank. I'm in a regional bank.
Better than a lot of other people, I'm sure.
I don't know about that. Not as much as you. But what interests me is their concern about being in some of these smaller institutions that had the attractive savings rates and CD rates. But now they're talking, you know, maybe I should be in a big money center bank, a Bank of America, a Citigroup, JP Morgan Chase. Do you see that flight to bigger going on here, or is it more isolated?
I do. It's funny, Neil. I woke up this morning to a text message from one of those four banks that I bank with. And, you know, they were inquiring if anybody knew of anybody who was having issues at other banks. So I do think that the big banks are going to use this to take market share. I think you're going to probably see that also, as I mentioned, not just in the, deposits and in the wealth management type of business, but also in terms of the mortgage-backed security business. I think you're going to see these banks just absolutely come in and continue to take market share, continue to take volume, offer potentially higher interest rates. And, you know, I think this inures very much to the benefit of the big guys, sadly. A lot of the regional guys, I think, will be left in the dust once this is said and done.
Wild. You know, that's a very astute read on the impact on just the mortgage arena, the mortgage securities market, which I had not considered. Maybe my friend should have gone to you, Bill, for this banking perspective and advice. Always good seeing you, Bill. Thank you.